Mark Tilbury or Millionaire Power. Retirement exposes a reality most investors spend their lives avoiding. The strategies that feel intelligent during accumulation quietly become dangerous when income stops and time becomes finite. The uncomfortable truth is this: market crashes do not care how disciplined you were in your career, and they punish retirees more severely than anyone else. That is why understanding the safest ETFs for retirees is not about growth, it is about survival. For decades, people are taught to think aggressively, buy more, hold longer, ignore volatility. That advice works when new income keeps arriving and recovery time is unlimited. In retirement, the rules change. Withdrawals turn temporary losses into permanent damage. Volatility becomes personal. And confidence built on past bull markets can disappear quickly when markets fall and income depends on stability. Most retirees believe they are prepared because they diversified at some point in the past. In reality, many portfolios are still designed for speed, not durability. They rely on assets that perform well when conditions are favorable and struggle when conditions tighten. That imbalance is rarely visible during calm markets. It reveals itself only during stress, when adjustments are hardest to make. The financial industry rarely explains this clearly. Safety is often framed as being conservative, outdated, or inefficient. Growth is praised. Protection is downplayed. But retirees do not need excitement. They need systems that function quietly under pressure. They need assets that reduce the need for action when emotions are elevated. ETFs play a critical role here, not as shortcuts, but as structural tools. When chosen correctly, they provide broad exposure, reduce single-point failures, and simplify decision-making. They allow retirees to remain invested without being exposed to unnecessary fragility. This is not about avoiding markets, it is about engaging with them intelligently. Another truth worth confronting is that cash alone is not safety. Inflation erodes purchasing power steadily, even when balances appear unchanged. Doing nothing feels responsible, yet it introduces a different kind of risk that unfolds slowly and quietly. Retirees need assets that balance stability with preservation of real value. The safest ETFs are not built for headlines, they are built for resilience. They prioritize diversification, quality, income consistency, and risk control. They accept moderate returns in exchange for predictability. That trade is often misunderstood by people who equate success with speed. In retirement, speed is irrelevant. Stability is everything. Market crashes are inevitable. Their timing is unknown, but their presence is guaranteed. The question is not whether they will happen, but whether your portfolio forces you to react when they do. The investors who survive downturns with confidence are not those who predicted them, they are the ones who planned for them. This conversation is about positioning yourself so that fear does not dictate behavior. It is about constructing a portfolio that absorbs shocks without demanding constant attention, a portfolio that supports your lifestyle rather than distracting from it. If you are approaching retirement or already there, this is not the time for complexity or experimentation. It is the time for clarity. By the end of this discussion, you will understand how experienced investors think about safety, why certain ETFs consistently hold up during market stress, and how disciplined positioning allows retirees to survive market crashes without sacrificing peace of mind. Stay focused. This matters. Prioritize broad diversification over concentrated returns. Retirement changes the purpose of investing. During working years, portfolios are built to grow aggressively because income is still coming in and time can correct mistakes. In retirement, that safety net disappears. Every decision now carries weight, and every loss has a direct impact on lifestyle. This is why broad diversification becomes more important than chasing concentrated returns. Concentrated portfolios depend on being right. They rely on a limited number of sectors, regions, or asset classes to perform well at the right time. When conditions are favorable, this can look impressive. When conditions change, the same structure becomes fragile. Retirees do not have the luxury of waiting through long recovery periods after major drawdowns. Diversification reduces the need to be correct about any single outcome. Broad diversification spreads risk across multiple drivers of return. Different assets respond differently to inflation, interest rates, economic growth, and market stress. When one area underperforms, another may remain stable or decline less. This balance does not eliminate losses, but it reduces their severity and frequency. For retirees, smaller and more controlled drawdowns are far easier to manage than sharp, concentrated declines. Another overlooked advantage of diversification is predictability. Highly concentrated portfolios tend to be more volatile, even when long-term returns appear attractive. Volatility becomes a problem when withdrawals are required, selling assets during downturns permanently locks in losses. Diversified ETF structures help smooth performance, which supports more consistent withdrawal strategies and reduces the risk of depleting capital too early. Diversification is also a form of humility. It acknowledges that markets are complex and future conditions are uncertain. No investor, regardless of experience, can consistently predict which asset or sector will dominate next. Retirees who accept this reality build portfolios designed to function across many scenarios rather than excel in one. This mindset shift is critical for long-term survival. ETFs make diversification practical and efficient. Instead of managing multiple individual securities, retirees can gain exposure to broad markets, sectors, or asset classes through a single structure. This reduces complexity and operational risk. It also limits the impact of individual company failures, regulatory changes, or sector disruptions. The portfolio becomes less dependent on any one event or decision. Behavioral discipline is another major benefit. Concentrated portfolios demand attention. They invite monitoring, speculation, and emotional reactions to short-term movements. Diversified portfolios are quieter. They do not encourage constant action. This calm is valuable during market stress, when emotional decisions are most damaging. A well-diversified structure supports patience by design. Some retirees worry that diversification means sacrificing returns. In reality, it means redefining success. The objective is no longer maximum growth. It is sustainable performance that supports decades of living expenses. A portfolio that grows steadily and avoids large losses often outperforms a more aggressive portfolio once withdrawals are considered. Stability compounds quietly. It is also important to understand that diversification is not static. It should reflect changing needs, not market trends. As retirement progresses, income requirements, risk tolerance, and time horizons evolve. Broadly diversified ETFs provide flexibility, allowing adjustments without dismantling the entire structure. Ultimately, prioritizing diversification over concentrated returns is a decision rooted in responsibility. It recognizes that retirement investing is not about proving intelligence or predicting markets. It is about protecting independence. The retirees who endure market crashes are rarely those who took bold risks. They are the ones who built systems capable of absorbing uncertainty without forcing difficult choices. Diversification does not eliminate risk, it manages it, and for retirees, managed risk is the foundation of survival. Focus on low volatility ETFs designed for capital preservation. As investors move into retirement, the primary risk they face is no longer missing out on growth. It is experiencing losses that cannot be recovered within a limited time frame. This is where low volatility ETFs become essential. Their purpose is not to outperform during bull markets, but to protect capital when markets become unstable. Volatility is often misunderstood. Many people view it as a temporary inconvenience, something that smooths out over time. That assumption depends entirely on having time. Retirees do not. When income is being withdrawn regularly, volatility has a compounding effect. Losses reduce the base from which future returns are generated, and withdrawals taken during downturns permanently weaken recovery potential. Low volatility ETFs are designed to address this problem structurally. They typically invest in companies or assets that demonstrate more stable earnings, lower price swings, and stronger balance sheets. In fixed income, they focus on shorter durations or higher credit quality. The objective is to reduce extreme movements rather than eliminate risk entirely. Capital preservation is not about avoiding the market. It is about remaining invested without being exposed to unnecessary turbulence. Retirees still need their assets to work. Inflation continues regardless of age. However, the path those assets take matters more than the destination. A smoother path allows retirees to stay invested through market stress without being forced into defensive actions. One of the most damaging behaviors in retirement is panic selling. Sharp declines trigger emotional responses, especially when portfolios are closely tied to lifestyle security. Low volatility ETFs reduce the intensity of these declines. Smaller drawdowns are easier to tolerate psychologically, which helps retirees maintain discipline when markets are unstable. Another advantage of low volatility strategies is consistency. While returns may appear modest compared to aggressive growth ETFs, they tend to be more reliable across market cycles. This reliability supports predictable withdrawal planning. When income needs are met with less fluctuation, retirees gain clarity and confidence in their financial structure. It is also important to understand that volatility is asymmetric. Large losses require disproportionately larger gains to recover. A 20% loss requires a 25% gain just to break even. A 40% loss requires nearly a 67% gain. Low volatility ETFs aim to avoid these deep drawdowns, making long-term outcomes more achievable even with moderate returns. Critics often argue that low volatility investing sacrifices opportunity. In retirement, opportunity must be measured differently. The opportunity to remain independent, avoid forced lifestyle changes, and maintain peace of mind carries more weight than outperforming a benchmark during strong markets. Capital preserved today creates options tomorrow. ETFs, DES. Designed around low volatility also simplify portfolio management. Their rules-based approach reduces the need for constant oversight. They rebalance automatically, removing emotion from asset selection. This structure is particularly valuable for retirees who prefer clarity over complexity. Low volatility ETFs are not a complete solution on their own. They are most effective when integrated into a broader, diversified portfolio. Their role is defensive by design. They absorb shocks and stabilize overall performance, allowing other components of the portfolio to operate without excessive pressure. Focusing on capital preservation is not conservative thinking. It is realistic thinking. Markets will fluctuate. Crashes will occur. The investors who survive them with confidence are not those who chased returns, but those who respected risk. For retirees, low volatility ETFs provide a disciplined way to stay invested, protect capital, and maintain control when markets become unpredictable. Stability, not speed, is what carries portfolios through market crashes. Balance income-generating ETFs with defensive growth exposure. Retirement investing is often misunderstood as a binary choice between growth and income. Many retirees feel pressured to choose one over the other, either prioritizing dividends for stability or remaining heavily invested in growth assets to keep pace with inflation. In reality, this framing is incomplete. The most resilient retirement portfolios balance income-generating ETFs with defensive growth exposure, allowing both stability and longevity to coexist. Income-focused ETFs serve an important purpose in retirement. They provide predictable cash flow that can support living expenses without requiring frequent asset sales. This reduces reliance on market timing and lowers the risk of selling assets during downturns. Consistent income brings structure to retirement planning and reduces financial anxiety. However, income alone is not enough. Portfolios built exclusively around income can quietly lose purchasing power over time. Inflation does not stop in retirement. Costs continue to rise, sometimes faster than expected. Without some exposure to growth, even a stable income stream can become insufficient in later years. This is where defensive growth plays a critical role. Defensive growth ETFs focus on assets that participate in market growth while exhibiting lower volatility and stronger fundamentals. They tend to invest in established companies, essential sectors, or broad markets with built-in diversification. Their objective is not rapid expansion, but steady appreciation that helps preserve real value over long periods. The balance between income and growth is what creates durability. Income handles today's needs. Growth protects tomorrow's purchasing power. When these elements are aligned correctly, retirees are less dependent on any single market condition. During market downturns, income can continue flowing while growth assets recover gradually. During strong markets, growth can replenish capital without sacrificing stability. This balance also improves behavioral discipline. Retirees who rely entirely on growth often feel pressured during drawdowns because withdrawals amplify losses. Those who rely entirely on income may become complacent and underestimate long-term erosion. A balanced structure reduces emotional extremes. It creates confidence during both calm and stressful periods. ETFs make this balance efficient and transparent. Income-generating ETFs provide diversified exposure to dividends, interest, or distributions without requiring individual security selection. Defensive growth ETFs offer broad market participation with built-in risk controls. Together, they form a system that is easier to manage and monitor. Another important consideration is flexibility. Retirement is not static. Spending needs change. Health expenses can rise. Family responsibilities evolve. A portfolio that combines income and growth allows adjustments without major restructuring. Income allocations can be increased during higher expense periods, while growth exposure can support longer-term objectives. It is also worth noting that income and growth are not opposing forces. Many high-quality assets contribute to both. The distinction lies in emphasis, not exclusivity. The goal is not to maximize yield or minimize volatility at all costs. It is to maintain a portfolio that functions smoothly across decades. Market crashes test this balance. Pure growth portfolios feel the full impact of volatility. Pure income portfolios may struggle if underlying assets weaken. Balanced portfolios, however, tend to absorb shocks more effectively. Income continues to support withdrawals, while defensive growth assets recover over time. This reduces the likelihood of forced decisions under pressure. The most disciplined retirees understand that survival is not about eliminating risk. It is about structuring risk, so it remains manageable. Balancing income-generating ETFs with defensive growth exposure achieves this by aligning current needs with future resilience. In retirement, success is measured by consistency, not excitement. A portfolio that delivers steady income, preserves purchasing power, and reduces emotional stress is doing its job. Balance is what allows that job to be done quietly and reliably, even when markets become unstable. Avoid leveraged, thematic, or complex ETF structures. One of the most common and dangerous mistakes retirees make is assuming that all ETFs are inherently safe simply because they are diversified vehicles. This assumption is incorrect. While ETFs can be powerful tools for stability and efficiency, certain structures introduce risks that are fundamentally incompatible with retirement objectives. Leveraged, thematic, and complex ETFs fall into this category. Leveraged ETFs are designed to amplify short-term market movements. They often promise 2 or 3 times the daily performance of an index. This design is attractive to traders seeking quick exposure, but it is deeply unsuitable for retirees. These products reset daily, which means their long-term performance can diverge significantly from the underlying index, especially during volatile markets. Over time, volatility decay can erode value even if the market trends in the expected direction. For retirees, this is not a theoretical risk. Leveraged ETFs magnify drawdowns. Losses occur faster and require disproportionately larger gains to recover. When withdrawals are involved, the damage becomes permanent. Capital that was meant to support long-term living expenses is exposed to structural instability that serves no defensive purpose. Thematic ETFs present a different but equally important risk. These products focus on narrow trends such as emerging technologies, demographic shifts, or popular narratives. While themes can be compelling, they concentrate exposure into a limited set of industries or companies. This concentration increases sensitivity to market sentiment, regulation, and disruption. Thematic ETFs often perform well during periods of optimism and underperform sharply when narratives change. Retirees should be particularly cautious with thematic exposure because themes tend to peak in popularity near market tops. By the time they become widely promoted, much of the growth has already occurred. Subsequent volatility can be severe. Retirement portfolios do not benefit from this type of cyclical enthusiasm. Complex ETFs introduce risk through opacity. These products may use derivatives, dynamic allocation strategies, or unconventional structures that are difficult to understand without specialized knowledge. Complexity increases the chance of unintended behavior during market stress. When investors do not fully understand how an asset behaves, they are more likely to react emotionally when it behaves unexpectedly. Simplicity is a form of risk management. Straightforward ETFs that track broad indices or well-defined asset classes behave more predictably. Predictability is valuable in retirement because it supports planning, discipline, and confidence. Complex structures undermine these qualities. Another issue with leveraged, thematic, and complex ETFs is that they demand attention. They require monitoring, rebalancing, and active decision-making. Retirement portfolios should reduce cognitive load, not increase it. The goal is not to manage markets daily, but to live without financial distraction. It is also important to recognize that these ETF structures are often marketed aggressively. Performance charts highlight short-term success while downplaying risk. Retirees must separate marketing from suitability. Just because an ETF exists does not mean it belongs in a preservation-focused portfolio. Avoiding these structures does not mean avoiding innovation. It means choosing tools that align with the purpose of retirement investing. That purpose is stability, clarity, and endurance. Leveraged, thematic, and complex ETFs are designed for speculation, not sustainability. Align ETF selection with withdrawal needs and time horizon. One of the most common and dangerous mistakes retirees make is assuming that all ETFs are inherently safe simply because they are diversified vehicles. This assumption is incorrect. While ETFs can be powerful tools for stability and efficiency, certain structures introduce risks that are fundamental, incompatible with retirement objectives. Leveraged, thematic, and complex ETFs fall into this category. Leveraged ETFs are designed to amplify short-term market movements. They often promise 2 or 3 times the daily performance of an index. This design is attractive to traders seeking quick exposure, but it is deeply unsuitable for retirees. These products reset daily, which means their long-term performance can diverge significantly from the underlying index, especially during volatile markets. Over time, volatility decay can erode value, even if the market trends in the expected direction. For retirees, this is not a theoretical risk. Leveraged ETFs magnify drawdowns. Losses occur faster and require disproportionately larger gains to recover. When withdrawals are involved, the damage becomes permanent. Capital that was meant to support long-term living expenses is exposed to structural instability that serves no defensive purpose. Thematic ETFs present a different but equally important risk. These products focus on narrow trends such as emerging technologies, demographic shifts, or popular narratives. While themes can be compelling, they concentrate exposure into a limited set of industries or companies. This concentration increases sensitivity to market sentiment, regulation, and disruption. Thematic ETFs often perform well during periods of optimism and underperform sharply when narratives change. Retirees should be particularly cautious with thematic exposure because themes tend to peak in popularity near market tops. By the time they become widely promoted, much of the growth has already occurred. Subsequent volatility can be severe. Retirement portfolios do not benefit from this type of cyclical enthusiasm. Complex ETFs introduce risk through opacity. These products may use derivatives, dynamic allocation strategies, or unconventional structures. Are difficult to understand without specialized knowledge. Complexity increases the chance of unintended behavior during market stress. When investors do not fully understand how an asset behaves, they are more likely to react emotionally when it behaves unexpectedly. Simplicity is a form of risk management. Straightforward ETFs that track broad indices or well-defined asset classes behave more predictably. Predictability is valuable in retirement because it supports planning, discipline, and confidence. Complex structures undermine these qualities. Another issue with leveraged, thematic, and complex ETFs is that they demand attention. They require monitoring, rebalancing, and active decision-making. Retirement portfolios should reduce cognitive load, not increase it. The goal is not to manage markets daily, but to live without financial distraction. It is also important to recognize that these ETF structures are often marketed aggressively. Performance charts highlight short-term success while downplaying risk. Retirees must separate marketing from suitability. Just because an ETF exists does not mean it belongs in a preservation-focused portfolio. Avoiding these structures does not mean avoiding innovation. It means choosing tools that align with the purpose of retirement investing. That purpose is stability, clarity, and endurance. Leveraged, thematic, and complex ETFs are designed for speculation, not sustainability. Build a portfolio that reduces emotional decision-making during downturns. One of the most underestimated risks in retirement investing is not market volatility itself, but how investors respond to it. Markets will fall. That is unavoidable. What determines long-term outcomes is whether those declines trigger emotional decisions that permanently damage a portfolio. For retirees, building a structure that reduces emotional decision-making during downturns is not a psychological preference. It is a financial necessity. During accumulation years, mistakes can be corrected with time and income. In retirement, emotional reactions often come with irreversible consequences. Panic selling locks in losses. Chasing recovery increases risk at the worst possible moment. The portfolio must therefore be designed to protect the investor from their own instincts when pressure is highest. This begins with structure. Portfolios that are too aggressive, too concentrated, or too complex demand attention. They invite monitoring, speculation, and constant evaluation. Every sharp movement feels personal. This environment increases anxiety and shortens decision-making horizons. In contrast, a well-structured retirement portfolio is intentionally boring. Its purpose is to function quietly, even when markets are loud. ETFs play an important role here because of their rules-based nature. They remove discretionary decision-making at the asset level. Instead of worrying about individual companies, earnings reports, or news events, retirees hold diversified structures that rebalance automatically. This reduces the number of decisions required during periods of stress, when decision quality is lowest. Another critical factor is drawdown control. Portfolios that experience large swings provoke stronger emotional responses. Even disciplined investors struggle to remain calm when losses feel sudden and severe. ETFs designed around diversification, low volatility, and defensive characteristics reduce the depth of drawdowns. Smaller declines are easier to tolerate, which increases the likelihood that investors stay invested. Income also plays a stabilizing psychological role. When retirees know that a portion of their portfolio continues to generate cash flow regardless of market conditions, fear loses its urgency. Income reduces the perk. In need to act. It creates breathing room. This is why portfolios that combine income-generating ETFs with growth exposure often outperform behaviorally, even if headline returns appear similar. Clarity is equally important. Every ETF in a retirement portfolio should have a clearly defined role. When markets fall, investors should understand what each component is meant to do. Uncertainty breeds anxiety. Confidence comes from knowing that the portfolio was designed for exactly this environment. Complexity undermines this confidence. Products that behave unpredictably during downturns create confusion and doubt. When investors do not understand why something is falling, they are more likely to abandon it. Simplicity supports discipline because it aligns expectations with reality. Another overlooked element is pre-commitment. Portfolios should be built with downturns in mind, not adjusted in reaction to them. Decisions made calmly in advance are far superior to decisions made under pressure. A disciplined ETF structure acts as a form of pre-commitment, limiting the range of actions available when emotions run high. Retirees who survive market crashes with confidence are rarely those who had superior forecasts. They are the ones who removed the need for forecasting altogether. Their portfolios did not depend on precise timing or perfect judgment. They depended on structure. Emotional decision-making is not a character flaw, it is human. The role of a retirement portfolio is not to test emotional strength, but to reduce the situations that demand it. When portfolios are aligned with this reality, investors are free to focus on life rather than markets. Ultimately, success in retirement investing is not measured by how boldly risks were taken, but by how consistently discipline was maintained. A portfolio that protects investors from their own worst impulses is doing its job. Stability, clarity, and structure are what allow retirees to endure market downturns without sacrificing control or peace of mind. The safest ETFs for retirees are not chosen for excitement, they are chosen for endurance. Market crashes will come and go, but disciplined structure determines who remains in control when they do. Think long-term, respect risk, and let stability carry the weight.